I have a day job and I'm starting to get something on the side. So everything is pretty brand new to us. Building all the funnels, building emails. You might have seen some random emails going out here and there. And I do apologize for any text messages that you're receiving that you were not expecting. But anyway, back to the story. So I've been trading options for a while, so I can pass the knowledge on and I can help the community learn what I've learned in the last 10 years. So transition that 10-year period down to condense it down to like maybe a week or two for you, for everyone. And then to show how to trade these strategies. There are 3 or 4. We don't trade everything all the time. It all depends on market conditions. We have a set criteria of what we look at and how we trade these strategies. So I'm going to show you one today just to give you a brief overview of what we will be covering in our main detailed 5-day course, which is starting next week. Some of you have already signed up. Others are still thinking about it. I hope they do. And then 100% money back guarantee there. You don't have to like even show up. If you don't like it, you can just test it out for a few days. If you don't like it, just email and we will return the money back. So without wasting anyone's time here, let's just get into it. I'm going to take you to the presentation that I have, and then there's some theory first, and then there is some practical information on the platform. Actually, I want to show you how I set up the trade, how to select the strike, expiration cycles, and what to look for, when we actually do this. So if you don't see the screen, just let me know in the chat and I'll do something about it. But looks like it's working. But I have seen a lot of people, and this was me as well, 5-10 years ago, didn't have a clue of what was going on in the market. I would just read a news article or see something on the TV, and I'll just go out and buy some call options, some put options, thinking that the market will go in my favor. That kind of strategy has only a 20 to 30% chance for winning, depending on where you buy it on the delta. The other side of it is when you sell that option, yes, you are locking in less profit, but you are increasing the probability of winning, meaning from 30% you go up to 70% and more probability of winning the trade. And that's what we do. We generate income by selling options. We define the risk most of the time. We manage the risk by either closing one side, selling another side, doing multiple different things, because with options, you always have an option. And we try to take advantage of all these kind of things that are available to us in the market, depending on the conditions that are out there. So I'm going to show you 2 strategies today, depending on how much time we have. A credit spread, which is one of our favorite ones, and then a 0 DTE iron condor. A lot of people have started liking this. We started trading this quite a bit in the market as well. It's not very high percentage game, but because there's so much interest in the market, I thought maybe I'd cover it to show how we trade it. Our win rate on the 0 DTE has been about 60 to 65%. Our other main strategies, the selling options, the credit spreads and all that, those are above 70%. So the 0 DTE is not really that bad, but again, a lot of things need to go in your favor, or should I say it this way, a lot of things should not go against you in that 0 DTE space for you to make money, because it's the same day expiration. Lots can happen in the day. It doesn't matter what time you select to pick the trade. The market can move here and there depending on there's a big news in the market or there's another catalyst in the market. It can just move things around. So I'm going to show you exactly how we trade things. First, some theory here. Why do we sell options and why don't we buy options? Well, there's plenty of research out there. How many options actually expire worthless? So much interest out there, open interest, which is open contract, people buying and selling options. And how much of it is actually expiring worthless? There's a big chunk of it which is expiring worthless every single day, every single week, and every single month, and quarters and leaps and all that. So I've been trading selling options for a while. It has been working, and that's what we stick to. We don't go out buying options at all. I don't buy long calls, long puts. If that strategy that you've been doing, I would look at it from a different lens and then see if the selling side works for you. And for that, we are here to help you. So hold your hand, look over your shoulders, see how you trade and how you're putting the trades on. Because when you join the 5-day challenge, there is unlimited amount of support right now because we are just starting the service. In the future, we will be starting that support cycle. So, if you haven't signed up yet, I'll encourage you to join and then just get into our Discord channel, because that's where the support system is. I'll be responding to all the messages. I am doing it right now. There's support on the email as well. So anyway, there's 3 rules that we follow. We trade high IV underlying. We have a way of checking in the high implied volatility, which I will show you on the platform. There's implied volatility, a technical indicator. There is average true range we look at for 0 DTE to see where the underlying has been trading in the last 14 days. What kind of range has it been going in? We stick to liquid underlying. We don't like to pay money in slippage, because if the underlying is not very liquid, then you end up paying a lot more in your bid and ask. Meaning you get in, now you have to, when you have to get out or do an adjustment to the trade, you cannot find the market get in and out of. So what I mean by that is, so you buy a very illiquid stock and opt in on an illiquid stock, the bid ask is probably dollar wise. To give you a comparison, on the high and the most liquid one, the bid ask is only a penny wide, or 2 pennies. So there's a big vast difference between liquid and illiquid stock. We stick to the liquid ones because the way we trade, we have to sometimes manage the trade, meaning you have to get in and out, do some risk management, adjust the trade mechanically, roll the trade. So for all these purposes, we have to be able to get in and out very quickly. So that's why we select only the liquid options. So in the liquid market, I would say there are probably maybe 40 names out there that you can trade, but we are big fans of futures options. So that's my go-to strategy. It has been for the last 3 years, and I've been learning more and more about it. And I can show you the trades that I will show you today are also going to be on futures options. You'll just see the difference between the capital efficiency that you get. You can trade twice as many trades in the futures options for the same amount of money that you can do in the equity or the ETF space. So that's why we like the futures options space. Now, in the futures option space, how many underlying assets can we trade? Maybe 5 or 6 or 10. That's the max of it. But because the markets are very macro-driven, they don't really move, not very high. It's not as high as your underlying tickers, the ETFs, and the other assets that you trade. So, by the way, if anyone has any questions, just raise your hand and just ask the question. I have no issues with that. I hope I have not changed the settings where you cannot ask your question. I think I left that open. But anyway, we scale into the trade. We start small. When we get the opportunity, we scale up. What do I mean by that? So, from the word go, we are contrarian traders. So when the market is down, I would sell a put option. I would not buy a put option. I would sell a put option, being a contrarian in the market. If we sell a put and the key market keeps going down on us, and if there is an opportunity, our rationale is still correct, we still believe in that market, we will sell another put. We will not run away from that market because we believe that being contrarian has been, very successful for us. And I can show you exactly what I mean by that on the platform. So again, a very simple bull put spread. You sell a put and then you buy a put, which is a lower strike. And that's how you cover the risk. That's how you define the risk. You get a net credit, which is your max profit. Your risk is between your spread width. So let's say the spread width is $10, meaning you're buying the sell $10 apart and you collected $2. Your max risk is basically $8 in the trade. And $8 in option roll means $800. Directionally, it has to be neutral to the bull put spread. But remember that we sell bull put spreads, we sell call spreads, we sell iron condors, we sell naked options, which is call options on our equity positions, cover calls, and we sell put options on when we want a short put, cash secured put, when we want to get into the trade. This is what the payoff diagram looks like. I'm sure you must have seen it. If you've been trading in the market, you must have seen that. This on top here is your sell strike. This is where you will be selling the option, and this is where you will be buying the option. And in the middle here, it will be a break even. So on the sell side, you deduct the money that you collect, you get to the break even point. What are the things that we actually look at when we trade the market? This is a very important slide here. This is what we look at. I will show this to you on the platform as well. Open interest is one of the most important numbers that we look at. The volume, the implied volatility, and the delta column. This is all I have in my view on the platform, and I can take it there as well. I can show you a very simple slide, and you will just see the columns that I have here. The columns are basically what I'm showing you on the slide as well. Delta, Vega, Theta, volume, and open interest. That's all I look at. The other things actually do not matter because everything falls in place if you have these tweaks and these numbers in line. Let's go back into the slide. So I want to finish the theory part quick so we can move on to the actual trade setup. Again, I made the arrow here. This is the short delta, short 17 delta, right here. It's just there. And then, so we're selling. How are we selecting the price? We are selecting the strike by 16 to 20 delta. We don't go any further away from that. When we sell, I target 17 delta mostly, or 18, and we buy at 12 to 13. Okay. And I'll show you exactly what I mean by that on the platform. When we do that, we get a 80% probability of profit, meaning an 80% chance that we can win that trade. I'm not saying that we will win that trade, but 80% probability is in our favor. Yes, the one we have given up for that. We've given up the unlimited, upside because we are capping the upside with a defined risk, but we have moved the probability in our favor from 20 to 30% to like over 70 to 80%. That's what we believe in. So it's a numbers game. So the more often you trade small amount, that income, you build up that passive income monthly every 45 days. That's our go-to expiration cycles between 40 to 45 to 50. 30 is very rare. If you see an opportunity, IV is high, we will trade 30, but most likely 45. Why 45? Because if the market moves against us, it gives us enough time to make some adjustments, to roll the strike, be mechanical about it, to move the spread out into the different months. Really, the P&L is very low when you go out further. And also, another thing, when you're trading futures options, the way they margin your account, meaning the way they collect money to initiate the trade, is based on span margining. Span margining works on volatility and day to expiration. So the further out you go, less money will be taken out of your account to initiate the trade. If you are trading futures options closer to the expiration, meaning you're doing it 10, 15, 20 days, you will end up putting more money down to initiate the trade. So that's not the reason why we trade 45, but that's another factor that's built into it. Next one, most important thing, 60% of the standard deviation. So I did this study very recently on SPY returns. If you look at SPY, which is S&P 500 daily returns, right? You calculate the mean of those returns over the last 20 years. right? Study the mean of those returns, and you see the standard deviation that it has been falling under daily for the last 20 years, you will see that 70 to 80% of the time, it has fallen under one standard deviation, meaning from wherever the mean is, you go out one standard deviation. The standard deviations can move based on volatility, again, but you will see that the underlying ticker, most of the time, has moved within one standard deviation of its mean. And therefore, when we sell within that one standard deviation as well. We don't go further out because then there's not enough credit. We don't go too close because then there's too much risk. We stay within one standard deviation on the border. And I'll show you that on the screen as well. So very quickly on this side, when the underlying ticker is staying within its one standard deviation, that is expected to happen 68% of the time. But in reality, I've seen it over 70 to 75% of the time in the last 20 years in SPY. And I'll dig that study out and I'll send it over if anyone needs it. I just couldn't get it handy today because I was running short on time. So this is what the bell curve looked like. When I said mean is right in the middle of the daily return. And when you go further out, these are the numbers that it has stayed under. This bar and then this bar. That's where most of the underlying actually fall in the long run. I'm not saying in a week or a day. In the long run, that's where it actually goes. Okay, next one is, just to give you an idea, on the other side, the two standard deviation is basically 90% probability of happening. 95, okay? Meaning 95% of the time, the underlying will fall within that two standard deviation from the mean. But again, if you go that farther out, you don't collect enough credit. When you don't collect enough credit, you don't have a good risk to reward ratio, okay? A good risk to reward means, let's say you're putting down $1,000 to trade, right? You've got to be collecting at least $150 or $200 in that trade, because we don't wait until final day of expiration. We take profits at 50 to 60%, and 50 to 60 of that $1,000 is probably $100. 50 to 60% of that $200 that you collected is $100. So your net return on investment is basically 100 divided by $1,000 that you put down. You actually don't even put down $1,000. You put down the max loss, which is 1,000 minus the 200, which is 800. So your net return is basically 100 divided by 800. That's the net return on just one trade. Now imagine if you can roll these up throughout the year in different underlying uncorrelated portfolio. That's how we like to trade as well. Like correlations have to be low in our portfolio, meaning we don't really trade highly correlated assets together. So if you have a position in SPY, I will not take a position in something that trades very closely, which is another NASDAQ. Because NASDAQ and SPY are pretty much the same thing. They move together. They're only a little bit away from each other. Okay, what else is very closely related? So GB, which is the bond market, and the interest rate markets are obviously very close as well. You know, the bonds and the equity markets are negatively correlated historically, but just remember, when things go down, everything goes down together. So there's no correlation when the market tanks. That's what happened in the COVID time. That's what happened in April last year when the whole tariff thing started. Everything just went down together, and therefore the correlations just don't matter when markets go down hard. When I say hard, means 5-10% down in a day. Next one. This is a live example. I think these are real numbers now. I did this presentation a while ago. I'm going to show you the stress numbers on the screen. What do we do to manage the trade? That's another important piece. How do we manage? We manage the trade by, let's say we went in 45 days to expiration. If there are more than 30 days left and our short strike has been breached or is getting breached, we will convert the spread, the credit spread or the debit spread, not the debit, sorry, the put spread or the call spread into an iron condor. So we balance out the risk on both sides now. So what we have done here is basically said, my contrarian view has been breached or has been, it has been impacted. Now I'm staying very neutral to the market, and I will decide which side to take off when the market moves next. So wherever the market goes, we then take off either the call side or the put side accordingly. If there are less than 30 days left, we don't stay in this cycle. If there are less than 25 to 22 days left, we don't stay in the current cycle. We go in the back month. So the front month is gone, the back month is available. We go to the back month, we get more time on our side, we collect more credit. When you collect more credit, you expand your break-even point. So let's say you initiated the trade with $200, your strike is breached. Now you want to roll the credit spread out. When you roll that credit spread out, let's say another 45 days, you will collect more credit. When you collect more credit, your break-even point will then expand again, meaning now you have more room to be wrong. This way, the market has to come and beat you because you have such big, area where you are safe. Like I said, 80% of the time you are safe. Only 20% of the time is when the market can come and, beat you. When we roll the trade, this is the criteria we follow. If it's less than 30 days, less than 25, we just roll it out in time, collect more credit, expand the break-even point, and then stay in the trade. Obviously, we don't go all in, very small size. However, this slide is also very important. This is what I have in front of my computer. Very small accounts can trade up to 5%, but that's again a big number. But what can you do in 5%, which is $500 for a $10,000 account? Actually, you can do a lot of things. You can trade one iron condor in any underlying ticker. When I say any underlying ticker, I mean, something that is $400 to $500, which is totally fine. You can do that. In the futures options market, we can trade anything under $500, and I'll show you right now. And you can collect any amount of money. So if you're doing the same trade in SPY, you're putting down $800 and you're collecting 200, you can do the same trade for 3 times less money in the futures option space. And you know that SPY and the features of it, they just run together. They don't go away from each other. Yes, there's a carry built into the future space, and therefore the price of the future is higher than the index, obviously. But when you're trying to collect the same amount of money with the same probabilities, futures options provide you that best capital leverage that you need. And we can do that right now. I will show you the difference between SPX and the futures option space. You can decide yourself which one's better, because they both trade the same way. All three of them, SPY, which is the ETF, SPX, which is the index, and /ES, which is the future, they all track each other 100%. There's no tracking error there at all. You can check by calculating the return and checking what the difference is. There will be no difference on the daily basis. Very, very small difference, because the carry that's built into the future and the dividend income that comes into the SPY. Anyway, there are limited spaces here, but if you sign up today, the first 15 signups are getting one-on-one with me. I can just check their portfolio, help them out with anything that they need, any questions. That's a one-on-one for the first 15 signups. But yeah, here's the link. I will drop this link in the chat as well, so you can just take a look in the meantime if you want to. That's the end of the presentation. But again, I like the practical pieces more. So I'm going to take you to the platform and then we can just do some trading here. Well, the markets are closed. We cannot put the trade in, but I'm going to do the setup. So I was talking about the /ES market, right? These are the futures, ES, E-mini, S&P 500 futures. That's the same thing. They're trading at 7011. Again, the best thing about this is they trade 23/5, meaning they trade 5 days a week.
We are seeing only the presentation. Are you sharing any the trade setup?
Wait, I think you're right. Why am I not sharing it? I think I've gone out of it. Sorry, let me reshare it. Hold on. Thanks for catching that, Sandal. Okay, so we're in the S&P 500 futures market with this /ES. I was showing you the options chain. This is what it looks like. The 45-day one is not available, but 39 is available, right? It's here. Again, I will not touch this Thursday one. It expires on Thursday. Usually these options expire on Friday, which is this cycle, week 3. And they expire on the 3rd week of the month. The 3rd Friday of the month is where the most of the expiration happens, 99% of the time. That's where the expiration is. So we trade the most liquid ones. Now, I want to show you the open interest and volume numbers first before we even touch the trade. So these are the columns I'm trying to show you here. So look at each column: volume and open interest on the put side, volume and open interest on the call side. I'm looking at here, volume and open interest. A few things to notice here. So in thousands, now if you want to know the price of one contract, it's really high. It's basically the index value, which is it's currently trading at 75, a multiplier of 50. That's the index value. That's the notional that you need. You can check that by going in here, tools, no, analyze. Anyway, there's a way to check the margin requirement for each underlying asset, which is, it will come to me soon. But for now, let's just start the trade like we decided to. Yeah, here, okay, futures. Look at it. ES, E-mini, S&P 500 futures initial requirement is $23,000. If you were to trade one single future of this, it will be $23,000 taken out from your account to take a long or short position in ES and ES E-mini futures. I was actually showing you the total net dollar amount involved in this. It will come to me again. That's the initial margin. Now, in order to trade this, we are trading a put spread. The put spread is my favorite one because there's a volatility drift built into the market on the put side. So because people panic first and then take action next, puts are always more expensive than calls. There's always some put skew. You call that put skew. Why? Because if I go from 7,000, if I go same distance back into the put side and the call side, you will notice that the put option is trading for a higher price than the call option. And that's because it's put skew, especially in the S&P 500 market. Now we can check that. From 7,000, let's go back to 200 points back to 6,800. The put is trading at $53. From 7,000, if I were to go to the call side to 7,200, it's trading at 31. You see that difference? It's almost twice. That's what we call the put skew. People panic, but they're very panicky when the markets go down, so they buy protection. When they buy protection, the protection price goes up. Due to the equivalence price, it always goes up, okay? And therefore, when their markets are down, the puts are even more juicier. The volatility is up, and you can sell heavy, juicy premiums when market is down. Before we go into the trade, a couple of the things that we look at. Again, volatility. I was talking about this volatility here. It's trading at an average right now. Again, S&P 500 volatility is same as VIX. You can pick that number up, 1482. You can check VIX. If I don't have it here, you can just check VIX. VIX will be trading at that. VIX is basically based out of 30 days of volatility in the S&P 500 market. So VIX is the implied volatility on VIX. So VIX actual number is 15, right? So that's what it is. And we saw on ES, the number was 14 point something. So very close. So VIX is built out of S&P 500, and therefore the implied volatility that you will see in these markets would be same as this. The next thing, okay, so average to rank. Now this comes in handy when we are trading the Iron Condor 0 DTE. This basically tells us what has the ticker done in the last 14 days, its average movement per day. If you look at this number, in my head, I always have 50 to 60 points every single day, meaning S&P 500 is expected to move 50 to 60 points every day, depending on where you're going on a particular day. My number is 50 to 60. Now, can we cover that 50 to 60 on any given day? I don't think so, but we can cover at least 30 to 40 if we time it right. If you time the market correctly, like we put the trade in at 1 hour after market open, take it off 2 to 3 hours after that, then you can get 30 to 40 points out. But 50 to 60 is really hard to get unless there is high volatility in the market. So this comes in handy when you're trading 0 DT, and that's why it's in front of me as my indicator. Let's set up the put spread quick. I'm going my sweet spot, 17 delta, right click, sell a vertical. Now, I'm selling the verticals here. Every futures options market has its different spread. The width of the spread is different for gold, it's different for oil, and every stock. Apple has a different spread in my mind. Nvidia, if I'm trading Nvidia, it has a different spread. Do I want to go $10 out, $20 out? Tesla has worked better on the $20 out spread. This is given based on whatever we've researched and whatever we've traded in the past. Apple works better on the $10 spread. Anyway, so each market has its own thing, and this is what we cover in our 5-day thing as well. Exactly, I'll tell you which market covers both where in terms of the weight. So this one is usually 25 points out, and this is how it's set up, because next available price that we will choose is 66.50, which is here, the 25 point out. Now, this is the credit you're collecting. Now, again, in the EF market, you have to divide this by 2 in order to look at the actual dollar amount that you're collecting. So anyway, let's look at the setup first. Just be mindful that because the markets are closed right now and this is a playbook trading account, the charts are sometimes off, but I'm going to try and change things and see if it works. There you go. That's the right chart for us. Okay, so what do we like about this chart? This is the best thing about the chart that we like. 86% probability in your favor. So meaning this whole gray area that you've covered, you are saying that the underlying will stay between this gray area. It's floating at 7,000 right now, and it can go up to here and up to there, and you will still make money. And that the probability of that happening is 86% right now. Let's say it's a little bit off because it's aftermarket. It's definitely over 80%. That I can guarantee. If you set the trade up early in the morning tomorrow, when market opens, you get the same thing. The number will be over 80. And that's what we like. That's why we say it's over 80% when we trade. So now let's look at the max profit, the max loss, and the break even. So max loss again, 125. Like I said, divide this number by 2. That's your actual dollar amount. And hover over here is 1125 max loss. Now, this is the magic part of trading the futures options, collecting this much money. And I'll show you exactly how we do this in the SPX part as well. If you confirm and send this, you can see the trade ticket. It's collecting $500 for you to trade it. Now again, S&P 500, again, the market is off a little bit. If you want to trade other markets like oil and Eurodollar, this number will go down to 300, and I can prove that to you by looking at a quick spread in the oil market too. My goal is to compare this. Now we saw this, right? So we're putting down $500. If I were to do the same thing in SPY, in order to collect $125 in SPY, I would have to go at least $20 out, I think. Now, 39 days out, again, because all of these underlying assets, they work similarly, therefore they have the same underlying, same expiration, same everything. You can compare all of these across the 3 assets. You will not find any difference. 17 delta put spread here. It will start from 665. Let's see. You'll have to go around to 650. I think. Let's try that at 650. Yes, I'm collecting $126. So that's a good point to compare. So let's just take it out. Right click, analyze this trade. I need to set up some slices here. 21. There. Again, 84% chance. Perfect. We like that. However, the difference is your max loss is $3,174 in this market. And look at the amount of money that you will be putting down. $1,374, right? To collect 125. Same thing. This is the exact same thing. The only difference I did not tell you before was the commissions that you pay. In the equity market, ETF and all that, you pay, I pay 65 cents on each option contract. That's how my account is set up. I cannot get it lower. Your account is probably different. But in the ES market, you will pay a little bit higher commission. So the way we trade, it's $7 to get in, $7 to get out. That's $15. Here, that same thing would be $4 overall. 2 to get in, 2 to get out, whatever. That's the major difference. The only sticking point between the two is the commission. But if you look at the amount of money that you are saving, so what can you do with the amount of money that you save? So you put down 500 there, you're putting down less than 1,500 here. You're okay, round it 3 times more. When you do 3 times more, you're going to do 3 times more trades in the futures market, right? You can collect 3 times more money. So instead of 125, your net collection could be 125 times 3, because now you have enough money to collect 3 times that credit. We prefer the futures option space more compared to the equity space. Okay, so that's why this is what we look at. The next thing, again, let's go back. So here we are looking at our trade again, 125, 1125. Same thing, like trying to show you the amount of money we are saving. Now again, look, see, this margin is always moving. So buying power affecting the future space is always moving around because it's based on span margining. It doesn't go up to 1500 like the SPY space. If you're wondering, well, I'm starting with 500, it can go up to 1000. No, it cannot. Unless you are very close to that person, we do not do. So we don't let our margin blow up like that because we are utilizing this money to trade something else and collect more money somewhere else. So this is a direct comparison between how to collect the same amount of money in two different markets. Again, next thing, what are we going to do if it breaks? So if it goes down here, okay, we will turn this into an iron condor. When we say iron condor, what I mean by that is we will sell the call side. Let me go back in there again and sell the call side. Right now, that call is trading at 17 delta right now, 16. But when the market is down, it's probably trading at 10 or something, right? So this is just for information right now that this is what we would do. This is what I would do if the market went against me, came crashing down on me. Because when you sell a put spread, you basically long the market, right? You're bullish. So you're collecting, I forgot to the delta first. I'll tell you the Greek. So because you're selling put spread here, you're collecting positive delta, 65. Now look at this in terms of futures, right? 65 means $6.5 or something every day. Theta, again, positive, $1.91. Short beta, you're always starting volatility when you're selling often, and if you can sell it for 275, you will be basically flat here for the day. So these are the Greeks. Just remember this, because now I'm going to turn this into an iron condor and then show you how the Greeks look on the iron condor. Same thing, call spread, vertical, sell it, and then 72.50, 30.75. It's already set up. So call side, 7.75. Call side is getting you more money, and that cannot be right. Possibly because the market is off right now. It's closed. But look at the call side. It's got such a positive drift into it that no matter how far you go, you will never cover the traded area. The traded area is the expected move of this asset. So it's trading here at 7,000. It is expected to move all the way in the traded area, which is now an expiration. But the way we selected put option, because the put queue, we were able to come out of that traded area and sell there. On the call side, it's got such positive drift to it that I've never been able to cover the shaded area on the call side. And that's what I'm trying to say. When I say cover the shaded area, meaning you are covering the whole expected move. If you do that, you will not collect enough credit. You can see that. So the expected move goes up to 7,400. If you're selling at 7,250 and you're buying it at 7,400, I don't even think that 7,400 is available, but let's say it is available. Buying it at, it's a very low delta option at $5. This will not get us anything other than something's off here. I'm not doing this right. The market, let me just take this off. This is the call spread, then it becomes this call spread. If you're selling it at 7,400, this number is not right. The $15 number, because the market is closed, it's showing you that. The price of this option at 7,200 is $20, and you're buying the cheaper one at 5. The market is really off. Because the market is off, it's showing us not the correct prices here. And therefore, maybe it is right. $50 on tracking. $50. That's interesting. We don't collect that much. Anyway, that's how the iron condor will look like. Actually, I could create a separate iron condor here because the spreads are off because of market close. But anyway, let me show you the iron condor setup. If you are interested, I am selling an iron condor at 18 delta on both sides. So let's just set that up on 18 delta. 16, 66.75, 66.50. And then on the call side, I am going 18 delta as well. 19, let's say, 72 to 25, 72.50. Okay, and we do 20. And then 72.50. That should set up our iron condor, which I'm trying to achieve on the other one, but for some reason the prices are look off and it's not giving us the right start. But this one should do. Let's see. Yeah, let me take this off. There you go. This is the iron condor I was looking at or trying to get to with the spread. For some reason the spreads are off. This $15 is not making sense to me. We can take that off. We have a call put spread here and then iron condor here. Get back down to 1 very quickly. $262 credit, $887 max block. Look at the amount of money that you will pay. Only $648 to initiate this trade. Same thing if you were to do in the SPY trade or SPX even, you'll pay 3 times more money. And I just told you that. So I'm gonna have to stop it here. I need to get going as well. If anyone has any questions, just please let me know. I hope you did not miss the broker side when I was doing the trade. Give me a yes on the chat if you saw everything. If nobody has any questions, I would encourage you to, whoever has not signed up, take a look at the site by itself. If this is something that will help you, again, there's a money back guarantee in there. If you don't like it, just let us know. But I'm pretty sure that you will love the content that we will put out in a week's time. I have to be online every day. Yes, recording available for 7 days after the program ends. Meaning the program ends on Friday. So from Friday to the next Friday, we will have the recordings available to you. I have no issues with that. You can join the Discord channel. I have a Discord community where I answer questions. You can join that, ask me questions and everything. But for now, I have to drop here. If you have any questions, just drop me an email. This is the email. It all comes straight to me. So just drop me an email and I will see everyone on the other side, hopefully in the challenge. Have a good day, everybody. Have a rest of the week, everyone. Thank you very much for joining. Bye-bye.